Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Krussman. Joined here once again with Ben Brayshaw and Dan Mickle. How are you guys doing today?
I'm doing great, Seth. I'm doing real well. How are you doing, Dan?
Really good. We're just happy to see that the rain stopped finally and sun's back out and summer's ready to get going.
I know. A whole week without you guys. It was actually some of the best days I've had in a long time.
Well, I hope everyone has been having as good a week as Ben. We sure have. You guys, we have a show for you today, and it's going to be focused on the market insights. We're going to unveil the market insights, and we're going to talk about navigating the second half of 2023 and what that can look like for you. Well, welcome. We're glad you're here. You could be doing anything today with this time, and we just appreciate that you spend it with us. Our goal here as financial planners with Brayshaw Financial Group, our whole reason for bringing you the show today is to just get into some good stuff for you. Financial planning. Some of it's going to be common sense. Maybe you've heard it. Some of it's going to be a lot deeper dive and maybe go right over your head. Either way, at some point in time, we love the opportunity to just grab a call with you. Grab a call, grab a coffee, come in and visit and show us what's going on. Let's have some fun in financial planning and get some stuff put together that's going to make sense for you to really be successful in your investing. Three-dimensional investing is what we do here at Brayshaw Financial Group and Money on Tap. We take a look at all sides of the issues. We bring, really a lot of different perspective and experience from all three of us to really bring a fullness to the planning perspective. And that's what we're talking about here today is we're going to be talking about the market insights. What have we learned so far from 2023? Where are we going? It's a great question to ask, especially at this time of the year.
It's a good question to ask. There's a lot of stuff going on, and there's a lot of speculation of what should have happened, what's going to happen, and where we're going. And I think this show should be. I'd like to say it'd bring a lot of answers, but it's probably going to bring a lot of questions too, because I think there's a lot of speculation out there that it's almost like they have the right next thing to say to make you move whichever direction they want you to move. It seems like in the greater scheme of the market world that we all so carefully trod through. And I think that's really important to understand, like, where are you invested so that you can really make sure that if the market's up or down today, tomorrow, or the next 6 months, that your well-being is not dependent on that move so that you can ultimately, like, for all the people who have acquired their wealth through the stock market, you didn't care about it every day. You went to work because it didn't make a difference. You have to make sure that your everyday living experience is not dependent on the good, bad, and ugly of the stock market every day.
Yeah, and don't let these theories and opinions that you find in the media in general, dictate everything that you do. Because coming off of the rough year that 22 was, every indicator you read was that 23 is going to be more of the same, and we're in for kind of torture and torment in the market. And we've had one of the best starts in history so far this year. So, it's never probably wise to be all in or all out, and definitely, don't read too much into some of the opinion you hear out there. It's best just to take a disciplined approach to this stuff, and hopefully we can counsel you through some of that with our second half outlook, but as well kind of explain a little bit what's happened in the first half this year.
I would even back that up with just the idea that so many people are, solely dependent on, stock portfolios. We met with somebody, recently, and everything's in the stock market, and after last year, they're like, we need help, and then they're like, the market starts moving in a positive direction, and they're not even back to where they were, and they're like, well, maybe we don't need help. It's you have to really, and the conversation we had was, you have to have a plan, and when you have a plan, you know what to do when certain outcomes happen. And when you don't have a plan, then you're just wandering aimlessly, and then you become a victim, and you don't become a designer.
Yeah, you need to have a rudder. You can't just ride the tides. You got to be aiming at something.
All right, we're going to get into it here with you here in just a little bit. But before we start talking too much about the markets, it is time for Money in the News.
And coming to us first up today from Jessica Dickler at CNBC, just 8% of new vehicles cost under $30,000. It's the least affordable car market in modern history, expert says. So, right to the point in the headline there, only 8% of the available cars cost less than $30,000, which is really incredible to think of it that way. I mean, I think we've all understood and experienced, through the pandemic, on the heels of the pandemic, with these supposed supply chain issues and chip issues that, the car market was going to be red hot and it's going to be difficult to find what you're looking for. But the affordability change is something that's drastic. And I think it's, certainly if you're in that market, it's something to be concerned about. For new cars, the average price, this is going through the end of May, was $47,892. Now, and 10% of all vehicles out there cost $70,000 or more, which is up 3% from just 5 years ago. And look, scanning the market, just 0.3% of new vehicles sold for less than $20,000, which compared to 8% 5 years ago. So again, looking at that time frame, basically pre-pandemic until today, the availability and price of cars is just skyrocketed. It's really, truly unbelievable.
Well, the article, the article does a good job explaining that the fact that, people are shopping for more luxury features in their cars. I mean, I got to be honest with you, I am too. I mean, we have so much technology. It's like, oh, this has a bigger screen, and this one, this one massages your back when you're driving, and I mean, there's a 1,000 different, little add-ons, and it's become the car wars, essentially, of like who has the greatest, coolest gadget.
It makes me laugh. My 6-year-old, every time he steps in a car, we did a little traveling lately, so it was a couple of rental cars, and the first thing out of his mouth, does this car have internet, Daddy? Like, none of our cars have internet, Max. None of them do. So,
well, that's the other thing too. I mean, remember when we went from roll-up windows to automatic windows? I remember thinking to myself, holy smokes, this is incredible. And your son's like, it doesn't have internet, Dad? This is a really low budget.
Yeah, it didn't have internet. It actually had an ashtray. So there's no internet in cars with ashtrays.
I remember my grandma had a 1970 Cadillac Coupe de Ville, and that thing had like electric windows in it. And I remember asking my parents, I'm like, how come we don't have electric windows? Here we are, like 1984, and she's got this old classic that has the electric windows and an 8-track, And we were just suffering with a radio. Oh, life was hard as a kid. I love the opportunity that I see here. And what I'm talking about with that is like, okay, so why? Why are the prices going and shifting the way that they are? Well, I think some of that has to do with how cheap money was. And I say was. What they've done is they've really adjusted their market up into a place where people previously, I believe, could afford that. And there's a section of, clearly there's people that are still going to buy the cars regardless of whatever the lending rates are. But I think we're going to see some changes happen. And what I suspect is going to happen out of this is we're going to start to see more of those previous like car companies that were like the Hyundai and the Kias, right? Same thing. They were kind of that mid-level economical vehicle that people could rely on. They had a good warranty. They provided enough for the price point. And we're going to see a new market created here because I just think that that's the pressure that's going to start to happen with the rates and the way that money is right now.
Well, I think also with the electric car market, that's changing a lot of issues as well because electric cars traditionally cost more, even with the tax deductions that exist out there. With all the stuff going on with the car market, I mean, some of these cars, they cost what, some of the first homes we looked at cost.
Right.
So it's a little surprising. I mean, we're not that old. I mean, we're all in our mid-40s, and it's just kind of weird. I like to say mid-40s.
I was going to say, I had a little nod on that one. But
you're welcome, Dan.
We're stretching that mid out.
But the thing about all of this stuff is that, we remember, I think our generation has seen the greatest growth in technology out of any generation. I mean, our kids, they grew up with phones. We never had cell phones. I mean, remember bag phones? And looking at the massive amplification here and going into this AI journey, I think it's a pretty opportunistic time to understand, hey, this is what's going on. But all of this technology is driving up the cost of everything. That's really what's the underlying piece here. That's my.
Ben, I'm concerned. We're the same age to the day, and I don't remember a bag phone. What's a bag phone?
You don't know what a bag phone is?
No, is that an East Coast, West Coast thing? Or help me out here.
I don't know either.
You're talking about the old bag cell phones. Remember they used to carry the bags, the cell phones,
yes.
the old bag
It's
phones?
like a brick. We call it a brick phone, I think.
Well, you're from
No, this is pre-brick. He's going back.
A brick with a
Like
backpack, like a whole harness kind of thing. You know?
Pretty much. It was, like it was a backpack with like a big old walkie-talkie antenna coming out the top of it or something.
If that thing didn't give you cancer, nothing will. I don't know.
Well, if you can't afford a $30,000 car, don't worry about the next article we have, which is the world's first fully electric flying car approved by FAA. Company now accepting pre-orders by Bree Stimson. This is coming from us from Fox Business. A California-based company has designed a car, a fully electric vehicle that also flies. It can drive up to 200 miles, and its flying range is 110 miles. I mean, goodness gracious, can you imagine hitting a traffic jam and saying, I'm out of here? This is fantastic. This group of entrepreneurs back in 2015 co-founded this company. They laugh because that's the time period in which Marty J. Fox in Back to the Future, he flew back in time to 2015 in his flying car. And so they marked that as their basis of beginning the company. $300,000.
That's almost as much as a house.
Well,
Yeah, it is.
Not,
Sorry.
It's not New Hampshire. New Hampshire, it's like $500,000.
Maybe a garage to put your car in. But yeah, it's an incredible story, and I love the Back to the Future reference. That was kind of the impetus for these guys getting going, is just seeing that part of the movie. But the idea of a flying car, which has been there forever, and I really can't wait for it to happen. I think 20 years of Boston traffic has kind of traumatized me a little bit. So those escape routes are something I've pondered many times. But being able to just pull over and elevate and be gone, that's really incredible.
I mean, there's going to be somebody who crashes into each other.
Oh, absolutely. That's the mayhem to follow that I'm worried about. I don't know if I want to be driving underneath the flying cars.
Yeah.
That's concerning, especially with the kind of limited range when these things run out of fuel.
100 miles is not that limited. I mean, that's less than the distance to Boston.
Yeah. No, I suppose you're right. I mean, for getting out of traffic and getting home, it's plenty. That's plenty of range.
Yeah. It's going to be like driving a boat, but everyone's coming from 360 degrees in every direction.
Yeah. Interesting story. Little pie in the sky, though, I think.
The rules and the regulations that they're going to have to start to come up with in order to regulate how this works out. I mean, cars failing and falling out of the sky. I hope it's not my house that's underneath them. And it's exciting at the same time. You think of the risk that's involved. Like, how much would it cost to insure one of those buggers? It's just nuts.
What about just hopping over tolls? I'm just going through my mind now, just driving along, just boop, bounce right over that toll, back on the road.
No, they're going to get you.
You make you $300,000 back.
I hope there's some kind of a luxury tax out there for that one for you. Just because you said that, Dan, I'm going to be shaking my fist at you as you
A luxury
bounce over that. All right. Up next, we have Sam. Yeah, Sam Altman, who's OpenAI's guys, is taking a nuclear energy startup public. Now, and thank you, Wall Street Journal, Jennifer Hiller, and Amaranth Remkumar, for bringing us this article. The first thing that caught my eye on this, you guys, was just that nuclear energy piece. It's an area that, if you don't know us at Money on Tap and Brayshaw Financial Group, is behind the scenes. We talk a lot about energy, and we talk a lot about sources, and we talk all of this stuff are just common conversations that we love to have. And Ben, I'll give you credit on this. You've been driving the nuclear energy being that next piece that we really want to start focusing on taking a look at. And I'm fully behind it. So I got excited when I saw this. Now, the article primarily focuses on not necessarily the technology. There's a little bit of baked in on that, how this is going to be kind of like a smaller type of nuclear energy and reactor, but more of the taking it public and how they're doing it. And it's nothing that we're unfamiliar with. It's just through the SPAC system. If you're unfamiliar with what a SPAC is, it's kind of a blank check kind of a company out there where people get involved or roll into these SPACs and they cut them a check to be able to, do the business that they want to do. It's a very common startup process today before they can fully go independent and roll out into the marketplace outside of these mergers or these SPACs or blank check companies. So I was somewhat disappointed to read more about like the how-to of a SPAC and where Sam is coming from, the Chat GPT company, and I wanted to hear more about the just kind of like the nuclear enterprise or this nuclear energy enterprise. I don't know what your takeaway was.
Well, I think there's a big overlap there, and not this company that Sam Altman's working on, but a prior innovation of it was a partnership with Microsoft, and they're invested in this basically because they're trying to develop their own electricity source, and the expectation is that as AI evolves and if it follows the course that some people predict and really takes over a lot of enterprise, it is going to require a ton of energy to operate. So these new ideas, particularly with a kind of a clean lean, is something that is definitely an area that's full of potential.
Well, last time I watched The Matrix, our body's about a D power source, so we can. If it's not going to be nuclear, it's going to be us. The article points out a lot of real positives to nuclear. And there's clean nuclear, which is really a big conversation. But the one thing that nuclear has over solar is it's 24 hours a day, right? And, the demand of AI is really scary. I don't think we really understand. We got big problems energy-wise in our country. The biggest problem we have is the grid issues. We got major grid problems all over the country. California being, I understand, to be the worst grid system. So that's really concerning for me because we can produce all this power, but we still have to get it somewhere. And if we don't take care of our grids or maximize our grids, we have a hybrid car, and I don't know what happened. We plugged it in the other day, and it said couldn't charge, insufficient power on the grid. Like, well, why is my car telling the grid it's charging an electric car that it's not going to charge it because it will run everything else, right? So it's just kind of interesting that the grid issue is, and the demand out there is already too high to fundamentally cover this. I mean, even if we've done articles, right, guys? I mean, on if everybody had an electric car, like you just couldn't charge them all. I mean, it's just impossible. So there's a lot of issues around this, and I think nuclear is really one of the only solutions that's really going to provide us with a long-term option. They did talk about SMRs, which I thought was interesting. It's like small mobile reactors or something, or modular reactors. Yeah. And we don't have any in the U.S. yet, but these are they're not the big tower, combustion chamber issues that, everyone's running around. And then on top of it, it takes up a lot less space than solar, so it's a more consistent power. We can control it a little bit better. I saw a whole solar field that was hit by hailstorm or something like that and destroyed the whole, solar, like with a nuclear reactor.
Oh, wow.
Yeah, we don't have those problems. We have other problems, but I think the only way to really solve the demand of energy, which is only growing in an amplified manner because of AI, that alone, that's why they're doing this. They know that the demand for energy on what they're running in the background is going to be huge.
Yeah, maybe this is the first opportunity to see what AI does for itself, right? When it takes on the sentient thinking process, challenge it with how do you feed yourself? Yeah. You need to develop energy to develop yourself.
Right.
Where are we going to get it?
Well, I think I don't know if I was taking this from the article or something else, but I was wondering if AI was saying nuclear was the best way to go too.
Well, they said AI is going to work on the development of these smaller plants, right? Yeah. I don't know that. It doesn't say whether or not AI responded to that and said, yeah, this is the way to go.
It's funny, too, because the other thing about nuclear is, and it mentions this in the article, that there's no greenhouse gases. And, if that's really your big concern, you say, well, what's worse, greenhouse gases or nuclear?
Yeah, you did mention, actually, I forgot about that, the nuclear fusion, combining the hydrogen and helium was what the Microsoft was paying for. It was in the next 5 years. I thought that was really cool, and I'd love to kind of tease that out of maybe another article somewhere down the road. What I did appreciate here with the SPAC is that Jacob DeWitt, co-founder, chief executive of Oklo's, which is the name of the company that Sam and Jacob are bringing to the market here, is that the SPAC is being used in a way to fund the purchase of these facilities, where typically the traditional business model has been the customer has paid for those within the grid systems or wherever they're selling the power to. That's how they funded or raised these funds to build these facilities. So funding that outside of that, I think, is a really cool way to be able to bring not a new technology, but I guess a revamp of a technology, a cleaner version of a previous technology that really looks like it has a solid space in the market to be a solve. You guys, that's going to do it for Money in the News. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about Market Insights Unveiled. Don't go anywhere. We'll be right back, and we'll navigate this second half of 2023 with you here at Money on Tap. Hey, this is Seth Krussman with Brayshaw Financial Group. Are you looking for a hassle-free way to invest? Look no further than Brayshaw Financial Group. With Brayshaw Financial Group, you can start investing with as little as $100 and enjoy a user-friendly platform with diverse ranges of investment options. Visit Brayshaw Financial Group and start your investment journey today. Brayshaw Financial Group, investing made easy.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. One of the things I want to just make sure I appreciate and recognize as people out there joining us in the podcast world, we appreciate you being here with us. And if you like or subscribe, send us a message. Let us know at info@yourmoneyontap.com. We've got some Money on Tap gear for you. We'd like to just appreciate you and thank you for subscribing and being with us at Money on Tap. We are talking about Market Insights Unveiled. We're navigating the second half of 2023. What have we come through? What have we learned, and what are we looking down the pipe at, and what can we start to position ourselves for? It's been a ride. There's just the conversation, Dan, you were talking about how 2022 was just rough, and that's just general marketplace stuff. Now, grateful that in a lot of our portfolios we did really great. We had a great season in 2022. But, we're listening to the market pundits out there and what everybody else has to say. And there was a lot of fear coming into 2023. It was going to be another, ho-hum doozy of a year. Don't have any expectations. And where are we at today? Market has done well. And as, we've talked about in, when we how many years have we done Money on Tap now? I'm like, we're in like 260 episodes, 2016. We've been doing it for a while. So we've had a lot of different market conversations in this time. And when I go back and think about some of those, it was the, I want to call them the Fab Five. I forget the name that we even used for it. It was the Netflix and Facebook. And what were those called?
The FANG?
Fan Mag.
Oh, Fan Mag.
Fan Mag, right. Yeah, so that was the deal a while ago, right? And that was how we had index conversations, like why is the index up when the majority of the S&P 500 is not doing all that well? It was driven by mega cap. And here we are in another season where, we're going to start to have some of those conversations again, where we've seen the majority of the index, so the market performance really hanging on some big names out there. And understanding, if you're into if you're indexing, right, that's one thing. What do we call indexing? It's trying to buy something similar to the index and the basket of stocks and do whatever that does. But if you're also out there and you're an individual stock selector or an individual investor, it's really good to pay attention to what is some of the underlying concerns or causes that we have going on here, and how can we be in front of this next move in the market.
I think the thing is that, we don't know what's going to happen in the market. Anyone thinks we have a crystal ball. It's not. We actually did do really well last year, Seth, you're right. And we actually had portfolios that made money last year. People would probably say we're nuts, but that's the truth. But this year, we're actually underperforming the market intentionally. We've taken a little bit more of a conservative approach because of a lot of things that's going on. But we're still positive. I think that's the thing. Because we always manage risk and we manage reward and time horizon and the investment objectives of us and our clients and what we're trying to focus on here. But the overall scenario is really trying to give a smoother ride. We've always focused on that here. And I think, it's not always perfect and it's not always better, but we've done things like use 200-day moving averages to, punch in and out of the market when the stock market's moving in a volatile direction. And that holds us accountable in some index allocations, which is unusual and different than a lot of different people who just say, we're passive forever. Like we're just going to buy the index and we're going to hold on forever. But, if you're performing at this, 15, 16% in the S&P, congratulations. But, when you look at your S&P holding, and we've talked about this at so many shows, it's only the first, 5 or 6 holdings or whatever that are like 50% of the fund usually. And that's usually the mega cap. That's the Apples and Microsofts. Those are the big boy companies. They are the majority of the investment. So when you buy the S&P 500 index, you don't own all 505 companies in the S&P. I mean, you just don't. You might own 50 of them, and then that's a problem. And they're so unequally weighted that you never really get a depiction of what the S&P 500 is doing.
Yeah, there's no doubt that this market has been pulled up by just a handful of names and some new names. NVIDIA is the one that comes to mind that's kind of just really he's blown the wheels off of it this year, up 200% at one point. And that has everything to do with this AI trend and chip making. And, for people who have been consistently indexing with the NASDAQ or invested there, then you've done very well this year, much more so than some of the other indexes. But the key to this thing is being diversified and picking on trends that you like and picking out sectors that you believe in, but having that diversity with the bulk of your investments so that you're kind of covering the field of what's out there is probably the best way to go. Yeah,
I think a balanced perspective and buying things you like and own really make the most sense. And I think that's what's carried a lot of people through this recession that wasn't or hasn't been. Let's put it that way.
Yeah.
We've got all sorts of things kind of crumbling around us. Or why are all these headwinds? Why is all the noise around this recession? We've heard it. And we've looked at the Fed raising rates at the fastest pace in history. That's probably the first thing that I would say in an organizational structure conversation, Dan. I think that's the first thing that really drove everything in that direction. And now the Fed has come back and said, well, we're not going to cut rates this year. We're going to raise it, which I've been mentioning for a long time. And I honestly, they're talking about cutting rates next year. I don't think they're going to be cutting rates next year. If they do, it might be an election move. I think that could potentially be a scenario, but I don't think that in their goal or scheme of things that, lowering rates is really their agenda. But they're lowering rates to reduce inflation. And I think that's been their goal. And so one of the things we've been talking about here is just that we've seen some marginal, not huge, not sweeping winds of change in the inflation world, but we're down a few percentage points from the 8-9 area to the 6-7. So,
I think what's interesting about that is when the Fed started their increases, they said that they were, looking at a couple indicators that they believed would be the foreshadower of inflation coming down. Specifically what they wanted to do was see the labor market, tighten up, to be less people employed. They wanted to see the stock market come down, right? Neither of those things have happened, yet inflation is coming down, right? So it's another one of these things where you kind of got to wonder, do they really know what they're doing?
Well, he kept mentioning 2%, right? So the idea of bringing inflation down to an average of 2%, and we're still at the 6 range. It's like to get an average of 2% over 12 months. Like how far below 2% do we have to get into deflation, right? that we actually get an average of 2. I think that's the biggest fear. But I honestly have seen just here locally, Dan, we've seen a softening of the labor market. I wouldn't say anyone's dying for a job here, but I would definitely say that activity is a little bit more interesting.
Yeah, I'd agree.
Now, stuff that has been interesting to see is that, GDP growth rate has remained positive. One of those typical things that we would look at is an overall economic expansion. The labor market has shown signs of strength and, steady job growth. You're talking about regionally, you're going to see some softening, you're going to see some different things, but overall, steady job growth has been there. Consumer spending has been, one of those things that you would typically take a look at. It's been high. And again, they're looking, the Fed has said they want the market to come down. That's been a target for them. And typically these other areas would be what they would use as indicators, not necessarily the market. Market kind of is more of a reactor to some of these other areas, but they've remained so high and so strong. I wonder what they're thinking. Like, what are they? I would point towards, some of the stimulus that they pumped into the, the liquidity that they have been pumping into the market continuously, and just kind of a continuation or a rollout of that. And then at the same time, we've seen some pretty catastrophic hits in this raising rate environment that, they'll say they never saw, but I don't know how they couldn't have if they really knew the underpinnings of those banks that did fail. So it's a fascinating time because there's so many things that we would say typically should be happening that are not.
Yeah, particularly the bank crisis. When we've seen that happen in the past, it would hit the market across the board, not just the banking sector and the financial sector, which have suffered this year for sure, separate from the rest of the market. But, none of these things that were kind of historically indicators of a recession to follow have really played out. So whether that recession has been staved off for good or is just going to be slower developing than expected, that's the unknown. But for sure, from the investor's perspective, things have been good. The market has cooperated here and rebounded significantly from where it finished up in 22, much contrary to most of the opinion you would have had coming into the year.
I appreciate everything that's going on here. And I mean, you guys all know that I do think that something's going to happen. I don't know when. And usually recessionary events and so forth, they're lagging events, right? So there's things that have to happen. And I'm raising these rates at the speed at which they've raised them, right? I mean, and at the volume, and we're not done. Like, that's the whole thing. We're far from done. I really do believe there is going to be some lagging break off. There's going to be some die off. There's going to be something that happens here. And whether it's this year, next year, whatever, I think in the next 5 years, we have something going on here. There's something that's going to happen. It's going to come to a head. You can't do this much, aggressive changes in our world and not have some sort of backlash. Now, I think there's been some real saving graces. I would agree with you guys. I mean, I think one of the unforeseen, huge, enormous, unforeseen, just what has changed our world is the AI thing. I would tell you that I don't think that any of what has happened with NVIDIA or any of these tech companies or chip manufacturers or even the energy sector for that matter, based on even just the article we did in Money in the News, I don't think any of that would be anywhere where we're at today in the market performance if we didn't have the AI conversation. I think every one of the things that we talk about, whether it's Microsoft's performance, Apple's performance, NVIDIA's, AMD, you name the companies for the most part, that has really been the central hub for most of them. Now, obviously there's some laggards here, right? There's some things that are just not really in that marketplace.
Well, just kind of following up on that point, supporting it, one of the things that I came across is someone described, and I thought this was kind of interesting, AI is the new electricity, right? It's this thing that's going to revolutionize the world. It's going to change how we do everything and how we power everything. And following that trend and bringing it back to the market, Ben, like you're just talking about, NVIDIA are up year to date, as of a couple days back here, 190%. Palo Alto Networks up 83%. Advanced Micro Devices, 76%. Apple, 50%. Microsoft, 43%. Google 36%, Amazon 55%, Tesla 113%, and Meta or Facebook 138%, and it's continued to go up since then. So these top companies represent over $4 trillion of market capitalization. So these are that top end of the index, right?
All driven by every one of the conversations you see on any news story, any news show is how they're connected to AI. And you're right. I do think it is the new electricity. I mean, if you don't understand what AI is doing, you have to experience it. You have to go through the process, because the demand AI is going to drive is just astronomical. The innovation AI is going to help culture it's incredible. I mean, it just really is an incredible thing. And I think all of these mega caps will only be driven further as we dive deeper into AI. So that's, I mean, it's interesting because I've listened to a lot of people talk about how, the tech sector is overweighted and so much growth. But what is tech? Does anyone know what the definition of tech is? I mean, I don't know anything that doesn't involve tech. I mean, it used to be you buy a car and it ran on, gas and it was an engine and you had a carburetor and now it's like, nope, I can't fix this because it's got too many wires.
You know what? That's so true. Actually, I was just having a really great lunch with my mechanic and the other day. And we were talking about tech and what it takes to actually get certified just to open up one of these cars today, and the liability that it takes, because, everything's a computer in there. And if it's not put back together exactly right, who owns the liability if those brakes go out or, random acceleration happens? There's just so many different factors in that car today that are not mechanical. You are now not only a mechanic, but you're some other kind of a technician. Like you're an engineer of a different value.
Yeah, you got a computer problem? You don't call IT, you call your auto mechanic. I mean, they have more training in tech stuff. It's unbelievable. What they know how to do with they're working on computers.
Explains why I can't get anyone to fix my lawnmower.
Seriously. But I think before we take the break, I think if you don't understand AI and you're not taking these pieces of the puzzle and putting them together in a portfolio, Dan, and things that you believe in, like as you said, if you're not looking at areas where that growth is really going to drive it, because if you don't understand AI, you don't understand why it's going to grow. And so that's really going to drive a lot of investments and successful investing, I think, long term. Now, is the market come down? The market always comes down. But when you actually start focusing on where value is, in big companies, and that, we like yield, I like things that pay income to us to own them. But if you understand value in general, you have to understand where that AI is going to place itself. Because AI is not a software program or something that is in of itself. It runs on other things. It is something you stack on top, and a lot of people don't realize that.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are unpacking the 2023 and looking forward in investing, and we're looking forward in what's coming down the pipe. AI was a really great topic for us to kind of wrap up that little segment on. It's going to speak volumes to where we're heading and what we're doing. And it's going to be a lot of fun to uncover that here with you on Money on Tap. Don't go anywhere. We'll be right back.
Hello, everyone. This is Dan Mickle on a Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about market insights and Unveiled. a lot has happened in 2023. There's been some surprises, and we've talked about some of those and some of the reasons why, or our understanding of those. And I'm looking forward to, looking at a few more of these surprises. For one, was anybody shocked by travel and what's happened in some of the travel industry stocks? It's really come through a challenging period, and what we're seeing is a very strong rebound just in the industry overall. It's easing with the traveling restrictions, the return of consumer confidence. Airlines, hotels, travel related companies really are experiencing a very full recovery. And one of the things that I've noticed as I've been around a little bit lately too, I kind of climbed out from underneath my rock. I hope everybody else has done it or felt the same. Is in the hospitality industry, and specifically inside of the hospitality industry, the restaurants seem to be the lagger in there. It seems so hard to find a restaurant that you can actually get seated in. Now, there will be plenty of seating, but having the full complement of service available, or even the full restaurant menu. That's one of the things I've just noticed is so hard to come by, is that full restaurant menu that they used to have. It's come down to almost a happy hour menu so that they can just get it out to you in time with what they've got the staff or the ability to do.
Yeah, I mean, I did some of my first traveling by plane in a long time lately with the family. It was my kid's first flight, so it was kind of an exciting time. But I wasn't prepared for the fact that the airports are absolutely packed. I mean, and this was before July 4th, and that was a horror story for everybody traveling over that week, with delays and canceled flights and just real turmoil in the system. But my experience in it, everywhere we went and every airport we stopped at, was just absolutely endless lines and just completely crowded. There's 2.65 million travelers per day at our airports, which is higher than any period since 2019. So that's proof positive that, in fact, travel is back. And the cruise lines are another sector. So just touching quickly on the airlines, they've all been up this year so far. And the cruise lines as well, even more significantly so. I think that probably has a lot to do with how far they fell during the total COVID close down and their just inability to sail ships. But they've rebounded very, very well, offering great deals from what I hear. I'm not really into the cruise world myself, but I know some people that are, and they're booking them up left, right, and center. They really feel like there's some competitive pricing that's led them back to, strong growth in the stock price as well.
Heck, I mean, with COVID and everything that happened, the $12-14 trillion of checks we've written, whether it's to us or to other people or countries, no matter where you stand in all of that, there's money flying through the system. I mean, everybody's getting money, so there's stuff to spend. And then you have this unforeseen market upside, right? This whole 2023 thing. I mean, a lot of people are not even back to what they lost last year. So we're kind of break even, but people are kind of feeling a little bit of relief and a little bit of, okay, like I'm better where I was. But you still haven't kept up with the inflationary event. So people are better off than they thought they were going to be, and things are a little, maybe I'll take a little bit of money out, I'll travel and so forth. And I think we're seeing that in some of the reports. I think the earnings across the board, whether it was the cruise lines, which have reported significantly better earnings for the most part. A lot of the airlines are record numbers and so forth. They've become significantly tighter as companies. They've gotten rid of a lot of junk in their books and stuff. So I think it's a little cleaner, a little sharper. So they're becoming more profitable a little quicker, and the volume is good. So there's a lot of things that are kind of coming out in the reports and the earnings that are better. I think everybody reported numbers that were significantly worse, which sent a lot of shock fears into last year. And where they're going to be, and companies are cutting. I mean, we've seen Facebook, we've seen Microsoft and Amazon. We've seen all these companies cutting jobs. So on some level, companies are getting stronger because of this. They're getting rid of fat, and that's important. So earnings are looking good, and things are happening in a way that I think is releasing funds and assets for people to travel, and that's good for our economy. It's staying off a lot of this recession that. That's one of the first places you really see a big pullback is, that kind of extra spending. Yeah,
well, people fear their, portfolios and pocketbook. They're certainly not taking vacations. Oh. So I think that's a good indicator that that's not the case. That fear is dissipating quickly.
One of the other things that we were talking about and we want to bring to our listeners is the strong housing market, a kind of unforeseen strong housing market. Now, there's kind of a very big story about housing. We've talked about this on shows in the past. And one of the things about the housing market is that the millennial crowd, that generation, never really saw their parents making money on real estate. So there was kind of this, already historical perspective where parents bought homes and they sold them for same dollars, and they saw that as a waste of an investment. What I don't think was communicated well to millennials was that a home is more than just an investment. Because parents thought, oh, well, I'll buy this house, it'll be worth more, and I'll retire off this. It's my biggest investment of my life. That's a very common story that we've heard from people. But since COVID, there's been a surge of millennials both keeping apartments in the city and buying homes. And then, or just buying homes and getting second jobs and moving away from the city. They've started to see value because it's a different value. They see the value of a home as like freedom. Like, that's my world of freedom. Like, I'm not tied to a condo in a place I can't leave the door if this ever happens again. They see that as a place where I have a backyard, and a home is more than an investment. So that continued strong housing market. I mean, here in New Hampshire, we have like historic lows in listings, and prices and so forth are rocket shipping. I don't know about you, Seth, but I was talking to a realtor the other day. They've got multiple offers, lots of them for cash, over asking. It's continuing. But he said it's lightened up a little bit, but still the volume is way more in the buyer side than the seller side. What have you seen, Seth?
It's kind of a mixed bag. It's a very complex market. For one, there's such a huge need. We are underhoused as far as people that need homes, need housing, and want housing, and frankly are trying to figure out how to get into this market. And the market here, if you take a look at the average home prices across the nation, it's like $440,000 or something like that for the average home. That's crazy, right? Just a little while ago, seems like a little while ago, it was like 2012. It was more like 250, 300, and so we've seen a dramatic increase in the cost of a home, and then you get sucked into this rate environment that we're in. My friends that are in the mortgage industry have just over the last year and a half, it has been a tough haul. They're really optimistic around what they're seeing right now, and people have continued to be able to purchase and buy real estate, and we still have this small offering of real estate here, so it's a very limited amount of real estate available on the market. But we have a lot of building projects continuing to push forward. There's a lot of new homes, and those new home prices, they're $800,000. That's kind of your average in that arena right now, unless you are kind of moving outside of the metropolitan area and getting further and further away. There are closer to that 400,000, but just driving by some of the homes that were built in 1970, 1980. Your classic, maybe 1 or 2 bathroom, 3 bedroom, 500,000. And I was shocked when Kira told me that the other day. I was like, how is that even possible? These are tiny little places in comparison.
Yeah. It's just, I think this whole housing, extravaganza, everyone wants to own a home. And the millennial is a huge generation. It's a huge population of our country. And all of a sudden we've got baby boomers selling, and we got, and not as many, because there's still like 80 million Americans to retire. So, they're not necessarily ready to sell their family home just yet. And so that's forcing home prices up. And, we just don't realize how many people are the exodus from the cities.
Yeah, there's the supply and the demand have really leveled off and kind of found their equilibrium. To your point, Seth, and I don't know if it was coming from the same source, but there's 1.37 million homes listed in the U.S. right now, which is the lowest number since they began tracking back in 2012. Right, mm-hmm. So there's that glut of buyer that was out there that was pushing things over, listing and cash offers only and all that. That's finally dried up, probably due to the rate environment, but the supply is still there. It's just it's lower. So there's the prices remain high. So there's a buyer for every seller, it looks like.
So I want to kind of wrap this up and have a conversation really quick with you guys. The recession that wasn't or hasn't yet conversation. I mean, where do you guys stand on this, from your perspective and for our listeners?
Well, every indicator coming into this year was that this thing is coming. And a lot of those indicators remain the same, right? That hasn't really changed. The things that are atypical is that the market has stayed strong, right? And that these rate hikes haven't had at least a couple of the desired effects, which was one, driving down the stock market, and number two, increasing unemployment. So, you have that trend to consider. And then there's the other trend that tells us that, historically looking at the indexes, if the first half of the year was positive, typically so is the second half. And if you look at the S&P as an example, since 1950, if it's up over 10% in the first half of the year, which it was, then the second half of the year you can expect a 7.7% average gain going forward. And, the simple fact that people seem to have shaken off all these fears, regardless of what the commentators say, and are spending money, living life, traveling, doing all those things, I think we're going to stay positive.
Yeah, that's a tough call. It's a really good question too, Ben. I think that's the one that we're trying to figure out and understand and answer here today. Is the trend right now is telling us that we're moving higher, right? Market's going to be moving higher. It might even go sideways, but as of now, it doesn't seem to pay attention too much to another rate increase. It might a little bit, but hasn't paid too much attention to bank failures, which are huge. That's systemic stuff that typically the market and our economy goes, holy cow, we cannot sustain. And it hasn't. And so part of me that wants to go along with, okay, the trend is our friend and we'll continue to move higher. We've got too much strength and too much going on, all of the things are positive moving in this direction. And the other part of me is that contrarian says, okay, don't get lulled to sleep. Pay attention. And so I'm cautiously optimistic. I see it moving higher. And what do I like right now? I really like value. I really think that we've had such a huge sweep upward in these technologies and AI. I think what's going to start to happen is AI is going to take a look at the marketplace and it's going to say, well, we really like value because that makes sense. That's a solid investment. So I'm going to go with that.
Yeah, I really like both of what you have said. I think cautiously optimistic would be an optimistic way of saying how I feel. I actually feel like, we can't stave off the things that we've put in place. Right? We've had things happen, and I think we've had some kind of unicorn events. I think AI is a unicorn event in the marketplace. I think it's really driven the market in a way that I think it literally caught the market from falling and literally carried it up. And that's all because the mega tech is, the majority of the S&P index, and when you buy an index and how it's allocated. And if you don't understand that, give us a call. But you're right, Seth. I mean, the bank collapse, we probably haven't seen the end of that story. The rates are going to continue to rise, and how well are these banks, ready to handle more rate hikes? And the truth is that even though you have money in the bank, maybe you have a CD paying 4 or 5%. Are you maintaining inflation? Are you working backwards in your life financially, and how are you managing that? And then the other piece of it is if you're walking into retirement, for the people who are just embracing retirement and the freedom of that, what does a 40% pullback look like for you? I think that's the biggest piece. Like, how do you weather that storm? And I think without a plan, and we were chatting about this earlier, without a plan, you really don't have the ability to mitigate all the woes and fears that could happen. But we all know that downsides happen, and they happen violently usually, right? Remember 2008, right? We had 2020. It doesn't matter if a nuclear bomb goes off in Israel tomorrow, the market's going to collapse, right? And so how do you mitigate those problems inside this? Because whether it's a recession because of intentional efforts or some sort of catastrophe or another war or whatever, all of these things are issues that we need to put foundations around to protect against, and try to give a smoother ride. And that can happen. It really can. We can do that for people. And depending on your risk and your tolerance and your ability and what your needs are, there are solutions out there than just buying the straight up stock market. But I agree with you, Seth. I think value is way, way undervalued.
You're listening to Money on Tap, and we have been talking about uncovering the marketplace and take a look at 2023. Thank you guys for another great show. If you have questions, if you're out there and you're wanting to understand more about your financial planning or how to improve your financial planning, give us a call at 855-226-8551 or info@yourmoneyontap.com. We'd love to sit down with you and take a look and see what we could do to help. That's what we're here for. Folks, be successful in your investing, okay? What you need to do today is what you got to do today, all right? I know that's repetitive, redundant, all that fun stuff, but probably infuriating to some of you. But it's what's important for you right now. Take a look at where you're at, understand it, and make a decision to move forward and be better, okay? Can't wait to see you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.